you have a bunch of people that
The same.
score and test the same way. And then you dealt with the complex problem that you've never experienced before, and everyone is trying to solve the problem the same way. So getting that diversity of experience in order to solve complex problems from a different angle requires people that have tried a bunch of different things. So I often, like, when I look at a resume and people say, this guy's done 6 things and he's only 2 years out of college. I'm like, great.
Hello everyone and welcome to a new episode from CareersTalks. Today I have Gautam. How are you doing, Gautam, first of all?
Very well, thanks for having me.
Thank you. I'm really excited, looking forward to this episode. You've been working in financial markets for 15 years and you've been a fund manager for 10 years. You worked in Credit Suisse in New York and now at M&G in London. So there's a lot to touch on in terms of your experience in finance. How do you manage a fund? What does it mean to manage a fund? So we're going to touch on a lot of topics, but I think it would be very nice to hear at first about your career. Walk us through like the pivotal moments in your career and what did you learn from those moments briefly?
Yeah, sure. So, as you mentioned, I've been kind of in the industry a little over 15 years. You say, 10 years as a fund manager, but realistically it's only been the last 5 years because and that's still, I think, a very short career in the span of the life of financial markets. I think 15 years happens in a flash. My path to investment management was kind of a very circuitous one, so I'd say I had no idea, and I think most people don't have any idea what they want to do getting into college, certainly even getting out of college. The attraction of investment management was when you're studying. I managed to get to on a scholarship. I played tennis growing up, and so I was in Connecticut at a place called Trinity College in Connecticut, and that area has become sort of a hotbed for life sciences actually in Boston, or then finance in New York, and so it sort of when you see your peers and people that have come before you apply their trade in markets, that seems like a cool thing to do. I had no idea what it was. I thought investment banking was actually investing, and I'm pretty sure there's a lot of kids out there thought that's what it was too. But I just got an internship through my college networks. In my junior year, was the year before you graduate, and then you kind of realize, there's stuff over here that's pretty cool. So it was like an equity research role. You get to meet companies, actually see how businesses work. That's kind of cool. I want to do some of that. And then serendipitously, you come back, started doing equity research, but then I actually found quant investing at Credit Suisse. Circuitously, from there, combined fundamental investing alongside quant investing and got a role in an asset management company at M&G over here in London. And that's kind of, fast forward 15 years later, I'm now helping run a macro hedge fund. So it's massively serendipitous, and you do this sampling, and ultimately, hopefully 15 years down the line, you find something that is a good fit for you.
Yes, no, definitely, I agree. I like how you said you didn't have no specific plan, right? I think now people come with I want to be this, I want to be this. So it's interesting that you don't have that role specifically in mind. You just went with the flow, and
I mean, how could you know? I didn't know anything about anything, and the I think at that age I expected myself to know what I wanted to do, and then you realize, and you talk to people and you learn about other people's stories, and you realize, well, actually it's pretty common. People sample a lot of different things in the early stages of their career, and then you have an understanding of your own interests because
100%.
You've been exposed more, and also your skill sets and where you're best able to apply your skill sets and match them up. So it's a pretty natural thing to happen, I think.
Yes. And in that career journey, what were the most transformative or challenging stages of it, and how did they change or pivot your career? What did you learn from these moments?
Yeah, so I mean, I'd say a few. The first one was I graduated in 2009. So I got offered a job. So I did my summer internship at Credit Suisse in the summer of 2008. Was made an offer in August. The offer was taken away in September.
We all know.
And then lo and behold, actually in November they called back and said, actually, why don't you just come along? And so just going through that experience, it's pretty. You don't know what you're going to do. At one point you think you're graduating, but you don't have a job in a different country, and you're kind of panicking. So going through all of those emotions, and then having a support system around you, even back then, people that were very willing to help me out with my career, offer advice, so experiencing that firsthand was pretty illustrative, because it then sort of sets you up for, okay, fine, there's a lot of uncertainty over here, but I can deal with it. And as a college student, you've kind of always been in a protected environment up until that. It was the first time it felt really exposed. And it sets you up. And the reason I give that example is because careers are full of these like uncertain moments. 100%. So like 1 year into my job, the guy who hired me, he left to do something else. And I was out of a boss less than a year into the thing. And then I was put into a different group. And the reality is life's full of these like uncertain moments. And learning to just be comfortable in uncertainty is something that is really important, especially in like high pressure industries. And I was given that exposure very early on. So I think that particular moment was quite illustrative. The other one was much later on. So I started as a fundamental equity analyst, then because of a maths background, I gravitated toward quant equities, and then combined the two. The team that I was working with at M&G, the lead fund manager left in 2017, and the CIO of the business came up to me and said, I like what you're doing. It's not what we've done a lot of before, so why don't you move to this other macro investment team? And you can carry on doing what you're doing, but do it with them, and see how it goes. And to me, that was again this like massive uncertainty, completely new team, never worked with any of them, kind of different philosophy, different everything, and now I'm gonna have to step in over there and carve my own space. But it was brilliant because one, today I'm a macro fund manager. And so clearly he saw some alignment of interest and skills. But the other part was, and we'll get to this later, I was doing stuff, like I was working, like I got to my job and I started reading financial reports and statements, and I started building models without actually having thought about why am I doing this? Like what is the philosophy? Like why do I think what I do works? And so and then I got into this team where all they did was think about the philosophy of investing and doing very little. And it was forcing myself to stop and say, like, why am I doing all of this? And so I'd say I didn't really develop an investment philosophy until about, halfway through my journey. And so that was a very transformative sort of period in my life. And that's kind of led me to where I am.
Nice, very interesting.
Yeah.
I think what would be helpful is if we touch briefly on your role as a fund manager. What does it mean to be a fund manager, and what are your key responsibilities?
Yeah, so it's a macro hedge fund, which means that we take directional sort of bets on different markets. So you can get long exposure, you can get short exposure, primarily because it's macro, it's at the index level, so you're investing at the S&P 500 level or the Euro Stocks level. So you're not trying to take calls on single stocks like Amazon or Google or whatever it is. You're just trying to get a sense of whether an aggregate market is attractive to invest in or not. And we do that across various asset classes. So equities, government bonds, credit, emerging market bonds, and FX. So those are sort of the instruments that we play and invest in. And it's because it's a hedge fund, it's got an absolute return mandate. So we you're looking to make money in up markets, down markets, kind of irrespective of the environment. People love you to be uncorrelated to equities. I try to explain to people that, equities usually go up, so you might want to be correlated to equities at some point, but that's by the by. So the day-to-day is essentially getting exposures to various markets, aligned with the investment philosophy that we follow, which is one that is steeped in sort of value and behavioral finance. And so, making trades and decisions, and we don't make too many trades. You try to make fewer trades and be much more crisper and clearer about the expression of those trades. And the rest of the time is just spent around doing a lot of reading and doing a lot of talking and philosophizing about markets, really.
So basically, it's a hedge fund, it's not an asset management fund, because I know there's a big there's different terms of frequency of trade and the clients, because they're willing to take more risk when it comes to a hedge fund. So it's a hedge fund, right?
It's a hedge fund. So you're right. So you can have long only funds in the multi-asset space, which are based primarily getting just long exposure to stocks and bonds in different parts of the world. And then the strategy that I run is actually, as you say, a hedge fund. So you can get long exposure, you can get short exposure.
Yes.
And you can have no exposure. So there's no sort of the home base is basically cash. So if there's no attractive trades around the world, you can be 100% in cash, waiting for opportunities. And a lot of what we do is just being patient, waiting for moments of volatility and fear and panic in the market to be contrarian to it. So
nice. That's very interesting.
So you're right about that, yeah.
Okay. And how did your experience change? So you started your career in New York, which is a buzzing city, very different from London. How did your career or life as a finance professional shift when you went from Credit Suisse in New York, to M&G in London?
Yeah, so it was, massively, but I think it was a function of different stages of the career that I was in as well. So when you start off as an analyst in equity research, it was about 100-hour weeks. That's just par for the course, really. So you'd be 7 to, if you're lucky, 7 to 7 plus a few hours on the weekend. And you were just thrown into the deep end doing a lot of things. So, there was, one research report after another research report after another research report. And there was just a lot of grunt work doing, where you just get the technical skills go on sort of this parabolic experience.
Steep curve,
and then, as I graduated up the ranks, and then when I moved to London, so part of it was, I think there's a lot of hustle in New York in general. Like you look around you, and a lot of people are doing things at the same time. So the city's got electric energy, and then part of the job is, you start and you just accept that that's what it is. But then as I moved to London, of course, my career had moved on a little bit at that point, and I was, more on the sort of
senior
investment decision making side of things at that point. So you still, and at this point, you're still thinking about, you should be doing a lot of things. So we're still like following companies, meeting companies, doing a lot of that, but not working 100-hour weeks, and then sort of thinking a little bit more about the job and philosophizing about why it is that we do what we do can have an investable edge. And I think London, the culture is one which allows you to just sit back a little bit more and do a little more thinking. But they're both extremely attractive, bustling cities for finance. I'd say New York and London are probably the two best cities to ply that trade in.
Yes. I have two quick follow-up questions. The first is, you said as a graduate, you're faced with this very challenging, demanding job, 100 hours a week. What kept you on going, or what convinced you that, okay, this is the right career path for me, I need to do this job and, become more senior?
Yeah, it's, I suppose there was always, because of my sporting background, it was the grunt work was always kind of a given.
Yes.
When you when you're training for a sport or whatever it is, you expect to put in the hard miles, and that felt like a path, a rite of passage. And I saw other people around me doing it, so I said, well, I'm not going to get outworked. It's kind of a mindset that doesn't have to be. I think having gone through what it was, I'm glad I did it, because I've done the grunt work, I've experienced, and then I can go back and say, well, actually all of that was pretty useless. But I keep telling people, so people say, well, you need to experience that for yourself. You need to go through the experience of, trying to think that you're going to outwork or out-analyze someone by reading more financial statements, by, spending more time modeling a particular company. And then realizing that actually, even out of the 20,000 pieces of information you pulled out, there's something else that comes in and actually disrupts the entire investment case. And that, like, getting that information edge is really, really hard. But having not gone through that, you wouldn't know.
Yes.
And so I'm kind of glad I did all of that. And it was, it felt like a rite of passage. So
yes.
It never felt like a burden. It was fun while it was happening.
I think as human beings, we always need to convince ourselves. Otherwise, even if you see everyone around you doing it, you need to sometimes do it yourself to really get convinced that this is not the way. So I agree on that one. And you said the pace at which the New York office was working on is faster than the M&G or any other financial office. Do you think that they're actually doing the same work but with less amount of time, or do you think that there's actually more of a success angle to working at a lower pace, having more time to analyze more information, especially in an industry like yours, where taking a step back actually and not being too dragged into this race can actually give you an advantage against other funds?
Yeah, I think the latter is very true. So the point you make about, and I wouldn't call it in New York, London. I was on the sell side research side over there. So, you're measured in productive sort of reports and everything else. So you have to kind of churn out a lot more. Whereas on the asset management side, you're much more about making fewer decisions but making better decisions.
Yes.
That's your entire sort of coaching, if you will, is about decision making, and utilizing information, synthesizing it, and then making sensible and hopefully productive decisions out of it. But in order to be able to make sensible decisions, you need to spend a lot of time thinking. So the one thing that you can automate a lot of things. You can automate information collection. You can automate processing of information. You can even systematize investment strategies, repeatable investment strategies. The one thing that you can't offload is judgment and thought. And so spending a lot of time, that's a hard thing to do, because once you actually sit and think about how many different ways it is to possibly beat the market, you can start tying yourself in knots pretty quickly. It's like, well, if I thought about that, why hasn't somebody else thought about that? And somebody else has done it, why didn't it work in this situation? And so having an environment that's conducive to encouraging that sort of thought of doing the job is a very good environment to put yourself in.
Yeah. I briefly want to touch on the compensation difference when it comes to the two cities on average for earlier levels, but also a fund manager level. How does the salary change for people based in New York versus being based here in London?
Yeah, so, I mean, I don't know for sure. My inkling is I think New York compensation levels are slightly higher. Certainly at the entry level, my experience is that is the case, and then as careers progress, they progress quite differently. So it's hard to sort of compare. But I mean, financial services is an industry that pays really well in general. So I think whether you're an associate, an analyst, or making or coming out of grad school and becoming a VP or whatever it is, it's a very well compensated sort of gig, whether you're in London or whether you're in New York. What I do think, what people value or tend to value a lot more, and this is I think a European thing, is I think base salaries are valued a lot more in Europe, whereas in the US they're very much more about kind of total comp and so sacrificing a little bit more, and that's I think more of a cultural thing. And so that's my experience. That's how it's sort of compared, but
makes
it's a
sense.
pretty well compensated industry in general, I think.
And across all regions, I agree. Internally, what teams do you interact with to ensure that the fund is going the right way, the right direction?
Okay. So internally, we've got various sort of asset class teams, and then we've got and most organizations will organize around asset class, and then within that you have research teams where you have sector specialists, and then you have individual fund managers that manage different sort of investment style funds, so like growth manager, tech manager, etc. We interact with all of them sort of in wider weekly investment meetings and discussions around markets, but we don't they're part of the information gathering process. So we don't actually, we don't offload a part of our portfolio to other people with the organization. So we we're responsible for every investment decision. Think of the portfolio as a whole, and it comes down to really the investment philosophy. So our investment philosophy is one which is again steeped in behavioral finance. So we look for periods in time where the market's reacting to what we believe to be more behavioral rather than fundamental factors. So think of, when you have an entire nation's equity market fall 15% in 2 days, which is what happened to Japan in August, so last month. You can try to come up with a fundamental rational reason as to why that happened. I probably won't believe you. There's phases in time where markets' risk perceptions change very, very quickly, and the proliferation of shorter term time horizons in investing amplify some of these volatility events. And what we try to do is we build an investment process around this philosophy that tries to take advantage of moments where the market gets very scared about something and panics, or gets very excited about something and extrapolates and then try to be contrarian to it. So when we face off with the research teams or whatever it is, we're looking for signs of this euphoria or panic in the way they talk about their investments, in the way they talk about their companies, etc. And so we within that context, having a dialogue with someone who's managing credit, someone who's covering tech stocks, someone who's is very helpful in that information gathering process.
Because from your side, you're looking, or you invest in all of these, but you also have teams specializing in each asset class, in each industry, right? So I guess these conversations help on a more detailed level how things are going.
And sometimes actually there are very rational reasons as to why something falls a lot. So a couple of years ago, Chinese education stocks fell 40%, and we're like, oh, that should be something that a contrarian investor would be interested in. And then you have a discussion with the analyst, and he says, listen, there's going to be an announcement from the government. We don't know exactly what it is, but they're talking about converting these business models into not-for-profit business models. That's a fundamental change. So sometimes, usually when things fall 30-40%, it's an overreaction. Sometimes there's a fundamental justification. So you need to have those resources and that specialist information to be able to make a judgment as to whether something is fundamental or not. And so having access to all those individual specialist teams. So, our company invests all around the world, has investment teams sitting in 3 or 4, on 3 different continents, and so you have all those resources at your fingertips, and the more you can utilize those kind of resources, the the better informed you can be when you make investment decisions.
Yes, 100%. You touched on a lot of interesting things, working internally, but you have the clients as well. I think a question that I'd like to touch on here is there's a lot of pressure on you both internally, but from the clients that basically gave you their money to invest it. How do you manage that short-term pressure when these drastic changes happen versus also long-term where you tell the client it's just about being patient, it's more of a long-term game? So how do you manage that long-term versus short-term pressure in your investment philosophy and how you interact with clients?
And that's a constant pressure, and in a way it's kind of an unavoidable sort of friction point. But equally, I think there's things you can do to enhance that relationship and sort of mitigate that. Core of that is having a cohesive investment philosophy, and a process that's then aligned to that investment philosophy that says that here's what we believe can generate returns in the market. And here's our process that tries to take advantage of this belief. So this is how you should expect us to behave in certain environments. So now you've set the scene. It's like, this is our philosophy. Before you give us money, please ensure that you buy into this philosophy. Now the reality is people will say that they buy into your philosophy, and then guess what? You get a 10% road down, and they're like, oh, we didn't. This is not what I thought it was. That's always going to happen. But the more articulate you can be about your philosophy and the process is designed, the more sort of transparency that you have with all stakeholders, by the way, because the pressures don't just come from clients. The pressures will come from the CIOs of the business, other fund managers talking, members within your team second guessing themselves. So if you can have a process that says that this is what we're going to do in certain situations, it might not work out, but as long as you're doing what you said you were going to do, your clients will hopefully stay along for the journey if they bought in for it. And it's funny because sometimes you'll have your doubters and they say, okay, but I see what you've done, you followed your process. And actually, if they can go through a journey and see it work, you can convert a lot of doubters into backers. So clients that were maybe relatively new and weren't quite sure, and then sees the process work out once, then twice, suddenly become your biggest cheerleaders. And then it becomes something interesting where they buy into your investment philosophy. And then your investment philosophy becomes their investment philosophy, they're preaching it. And then suddenly they're internally championing you. So it can be a very self-fulfilling prophecy on both sides, which means that if you are very articulate about it, if you bring all your stakeholders along the journey and they can see it working, then you've kind of suddenly enhanced your distribution and your and the way you talk about it, and that sort of pressure management stuff all goes away. So it can work both ways.
100%. The communication and trust aspect I feel is key here, because if you're, most of the time, assuming there's sometimes you need to behave in a slightly different way because markets are super dynamic, but most of the times you're behaving the way you communicated earlier to them. So
and just one thing, the flip side to that is, if you said you're going to behave in a certain way and you don't, that just kills, that's a deal breaker. Because, so one of my mentors told me this story. Very early on in his career, he had, because of, this was a contrarian investment philosophy, and he had a client that committed capital, said, I like what you do. I know you're contrarian. I know it's going to be scary. Just follow your process. And I think in one of the crises, I think it was the European crisis, where the philosophy said, you'd have to step in and buy equities when they fall X amount. And for whatever reason, I think the strategy wasn't able to do as much. And the client came up to him and said, I would have been okay if it didn't work out, but I expected you to do what you said you were going to do, and do something that was emotionally very difficult for most other asset managers to do. And that kind of learning moment for him was, you don't have a leg to stand on if you don't follow the process that you said you're going to do.
100%.
People will understand if it doesn't work out, but you've got to do what you say you're going to do.
You need to commit, yeah.
Yeah.
And this brings me to a question of markets are very dynamic. There's changes happening short term, long term. How do you adapt your strategy to these changes in a way where the client tells you, whoa, like we didn't agree on this, right? Is it like, if there's something that might be slightly different than the philosophy, you give them a heads up, or overall in general, how do you adapt that strategy to these dynamic changes?
Yeah, so markets are very dynamic, very complex, but in some ways, the sources of inefficiency in the market are pretty much the same as they were, over the last couple of decades. So if you think that the sources of inefficiency are just human actors and agents involved in the price setting mechanism of markets as we do, then those errors of over extrapolation, both on the upside and the downside, repeat in different asset classes, but in a similar fashion. And so in some ways, what you don't want to do, so where you don't want to adapt is, technological progress means that, how you trade, your speed to market, all of that, you need to adapt your processes. Your information gathering can happen in a lot more efficient manner. You can utilize, machine learning models to get your sense of sentiment and that kind of stuff. So you can develop your technological tools to help with the information gathering process. You can develop your technological skill set to execute better.
Yeah.
All of those things. So you need to adapt along and build sort of a culture and an organization that has that continuous improvement. Where it's very risky is to actually change your core philosophies. Hopefully you've thought a lot about the core philosophy, and that's repeatable across a range of different scenarios in markets. And that can be sort of enhanced, or you can sort of interpret it in slightly better ways over time, but that really shouldn't be changing. And so it's a constant balance of making sure that your core principles and philosophies are the same, but you're still being very efficient in how you sort of express those philosophies.
I think adaptability, as you said, is something very important. As long as adaptable and you communicate that part of it, then I'm sure clients would be understanding most of the times. If there is, let's say, one drawback of your strategy, or one thing you'd change, let's say, what would that be?
So the philosophy that we employ within our strategy is one which is, again, we're trying to take advantage of human emotion manifesting itself in sort of panicky or euphoric manner, and the process that we built around it is a framework which stops us from getting carried away by the same emotions that we're trying to expose. So we have this valuation framework, and we just say we'll never contradict the valuation framework. So and the reason for that is, as we know, value strategies work in periods of time and they don't work in other periods of time. And so there are degrees of freedom of interpretation of valuation.
Yes.
That we don't offer ourselves the luxury of having those degrees of freedom just to stop ourselves from being human. So I think there's a lot of, attractive investment opportunities that we've passed on. And you could look at this entire phase from in the post sort of COVID era and the proliferation of a lot of these AI-based companies that we haven't invested in, by being dogmatic about that valuation framework. But equally, that valuation framework stopped us from chasing the tech bubble and actually got us on the right side of many crises. So it's a framework that being dogmatic about has helped us navigate many other cycles. And so I don't know if I would change it, but it's certainly a drawback. So there's certainly attractive investments out there that we'll miss out on because of this process that we put in place to stop ourselves from getting carried away from and doing the things that we're trying to exploit.
I think it simply boils down to risk and reward. and how much that trade, you reach the right balance, and you've tested this philosophy across years, and you see, okay, I might be reducing the risk slightly, and there's rewards I'm missing on, but long term the gain is sustainable, let's say, or consistent.
It's we're not going to chase bubbles because of this framework, but equally we're going to miss some big investment opportunities, and that's just what you get with
100%. So I think we've talked about managing clients, and also you've touched briefly on improving the strategy with emerging technologies and developing technologies. Can you touch a bit on that? Throughout your 15 years in financial markets, how have you seen overall in general strategies, or your specific strategy, change with these new technologies and with this heavily data-driven approach that's being adopted across industries and fields?
Yeah, so I think I'll give you a personal experience actually.
Please.
So when I started researching fundamental equities at M&G, I was attached to a thematic fund, and the main goal of the fund was to kind of go around the world, find some of the most innovative companies and invest in them. So we invested, one of the early investments was in this company called NVIDIA, which was trading at $22 a share before the split adjustment. So in today's terms, it was kind of closer to $1 a share. So that was the best investment we'd ever made. The worst investment I ever made was then selling it at $100 a share.
Okay.
Thinking that
we got me excited there.
Yeah, thinking we had made 5 times our money, only to realize and see what happened subsequently. But the story over there was, as we were doing that, I noticed that like there was this common thread tying across all the most innovative companies. And that they were all sort of either involved in, or directly or indirectly, in the proliferation of something that now everyone talks about. So everyone's talking about AI, but a lot of these companies were actually benefiting. So machine learning at that point, which was the AI application, was being applied in other domains. So like in life sciences, in drug discovery, in image recognition, but it wasn't being used in finance. And so a colleague and I sat down and said, well, these algorithms are very good pattern recognition. A lot of what we do in finance is pattern recognition. Why are we not trying to build machine learning based investment algorithms? And so we actually, I mentioned I did some, I helped start the quant equities business at M&G, where a colleague and I basically sat down. It was his sort of, he coded up the first ML model, essentially utilizing a kind of a database that we built up through internal fundamental data, essentially, and then started trading on a very small amount of internal capital. Had ridiculously good results from it. Said, okay, we should put together a team with this. So we found individuals within the organization that were interested in machine learning, brought them together, built up our first kind of prototype model, built out the platform, and then actually pitched it to our CIO and said, what do you think? He said, this is awesome. Give us some seed money. And so there's that fund now is about $1 billion. Wow. And is coming up on a 5-year track record. And so that was just a simple sort of seeing technology being used cleverly in another space, and saying, so now you can go across different asset managers, and everyone's got like some AI-based investment algorithm. But I think for, at the time we were doing it, which was 2016, 2017, no one even knew about this. And so that gave us a bit of a head start. Now, the business is kind of taking on a life of its own over there. And so when you talk about, really utilizing technology, well, those same capabilities can now be used for, if a big part of what you're trying to gauge the emotional state of the market, you can use a lot of these algorithms to get not just sentiment, but get
prediction or...
Well, you can sort of get a sense of where news flow is going. Yeah. So you can get intensity of news flow. You can get, what tone is being used when people talk about markets. And what you're trying to do is find those periods of time where the narrative is being driven by price. And you can use technologies now to understand that. So oftentimes, basically, you have a story, and then the price reacts to the story. You know, whether it's a political event or a natural catastrophe or something like that. There's news, and then the price reacts to that news. But oftentimes, what we're looking for is where you have price being the key source of news, and then the narrative follows the price. That's where the human emotion kicks in. Now, there's various technologies and techniques that you can use to actually visualize that and bring that to life. So there's all of those things that we're bringing to our investment process on the macro side, but utilizing technologies that we built for, you know, our early ML-based investment algorithms.
That's a very interesting story, like that you took the risk, and I think this is a lesson that young professionals can learn from. If you see something emerging, whether it's a technology or a trend that you think you can apply to your work, I think that's a great lesson of try to slowly bring a colleague that you think might help or have the skill set where combining both skill sets can help you deliver this fully, which is what you've done. So it's very interesting story. So in terms of you managing, you know, high stake investments, you deal with different professionals across different teams. How do you try to keep your team motivated and driven, especially during the challenging times that you've mentioned?
Yeah, I think there's leaders that lead through example, and then there's leaders that kind of inspire and motivate through words, and both I've seen both models work, but it's a very personal thing. So for me, I've never been an inspirational speaker. I've never been someone who's going to go out there and get rally troops behind communication. I think it goes back to my sporting days or whatever it is. So I think having a shared belief and buy-in to doing things a certain way within a broader organization, and then just showing people by example how that works. That's been a style that's worked for me really well. There's no one size fits all, but that's kind of been my style. Equally, in investment management's a weird world where, you know, decision making is a pretty flat structure for us. So, you know, I'm responsible for the fund that I'm responsible for, and, you know, there's other members of my team who, you know, been around longer or whatever it is, and they've got other responsibilities. But, you know, the seniority and that kind of stuff in terms of age doesn't really come into play. But what does help actually is having that experience around you means that, like, just because I'm a decision maker on an investment fund doesn't mean that I need to be setting the example in every aspect of what we do on a day-to-day basis. There's other people over there who are exceptionally good at interpreting economics, and they will take the lead because that is what they're good at. And so, you know, this isn't like the president of an organization. It's a very self-organizing a way of working, which I think is actually a very good one.
Yes.
I think we make the mistake in fund management of elevating the PM or the decision maker in a way that organizations are now realizing that, you know, having a good career research analyst is probably worth its weight in gold. And so you want to sort of elevate different parts of the decision making process or different parts of the information gathering process and command the aura around it that it deserves, so that people will inspire and aspire to those things, and it might be a better fit for them. Don't get me wrong, like, you know, in the PM role and the decision making role is a very, very important one. Probably still the most important, but the other ones are equally important.
100%, which I think gives them a boost in their careers, right? If you tell someone in your team that, oh, actually this person worked on this, by the way, he led the initiatives on XYZ,
Yeah.
So I think it's also good for their careers to be
and also they don't have to success, the way they define success in their careers is going to then be different. If you're not comfortable making decisions in pressure situations, but are very good at interpreting complex data sets, why would you point your entire career onto sort of quick decision making when you've got this massive skill set that's so unique and so valuable? And equally, you should be rewarded for that particular skill and not be pushed into another area.
100%.
And I think we're kind of getting around this in the investment management world, but historically that hasn't been the case.
And this brings me to the question of developing talent, right? When hiring or mentoring young professionals, what are the qualities that you look for, and what advice do you have, like, for ones who want to enter the field in terms of how to set themselves apart? How can they set themselves apart, basically?
Yeah, so I think, and people talk about diversity a lot, I think a diversity of I call it the sampling. So essentially, people that have tried a lot of different things are very interesting to me. So if you've given a different industry a go, if you've given different fields within investments a go, and it's not historically it's always been like, well, this person's tried 5 or 6 different things. This person's a risk because they're probably going to move on to the next thing and the next thing. And the reality is, having that diverse experience of having looked at credit before you looked at equity, looked at, studied life sciences before coming into, asset management, all of those experiences actually help you think about a problem in a very different way. Because oftentimes, if you've been schooled in theory in one way, you've been schooled technically about how to analyze something in the same way, you'll test amazingly well, you'll interview great, and then you have a bunch of people that score and test the same way, and then you dealt with the complex problem that you've never experienced before, and everyone is trying to solve the problem the same way. So getting that diversity of experience in order to solve complex problems from a different angle requires people that have tried a bunch of different things. So I often, like, when I look at a resume and people say, this guy's done 6 things and he's only 2 years out of college, I'm like, great. This is and he or she might not last. They'll probably move on to the next thing, but it's incumbent on you to make their job interesting
100%.
enough for them to want to stay and keep them engaged and move them on to something else else. So that's a challenge for development. But diversity of experience and hunger for knowledge is a very valuable thing.
I cannot agree more on that one, definitely. When it comes to skills of becoming a good fund manager, so as you mentioned, there's that early part of the career where diversity is important, but slowly as you progress through your career in asset management or hedge fund, what really makes a good fund manager or portfolio manager? Is it their emotional intelligence dealing with clients, or is it more emphasis on the analytical skills? Like, what do you think is the right balance?
So I think, I'm almost certain that it's about understanding your own emotions as a fund manager. So learning, developing an investment philosophy, you need to have one, you need to really buy into one. You can't adopt somebody else's investment philosophy, because when it stops working, you start questioning it. So an investment philosophy has to be one that you've really thought about, hopefully written it down and rewritten it down multiple different times in different ways in order to really break it down and then buy into it as a person. And then once you've done that as a fund manager, understanding your own emotional state when you're interacting and how you make decisions. So people say, well, that was the wrong trade to make. And I say that might have been a wrong trade for you to have made, because you don't know how you're going to I know that if something goes a certain way in my portfolio, I know my emotional capacity to deal with that, and that might not be the same as your emotional capacity. So investing is such a personal. So within the framework of a shared philosophy, you can have hopefully not different positions, but certainly different position sizing. Even within certain risk parameters, you can have different position sizing, because different people have different emotional tolerances of how they're going to respond to drawdowns, etc., etc. And actually learning about yourself and how you're going to respond is the most important aspect of being a fund manager. How are you going to deal with those situations when the pressures are coming from the clients? How are you going to do the right thing? And I think that journey, and therefore being very honest with yourself, and keeping a diary. I think the best thing you can do as a fund manager is to keep a diary and actually write down how you felt about every single trade. Because guess what? We'll recreate history. We'll say things that we felt or did which are completely not the case. I go back and I read my diary and I'm like, I don't remember it being that way. So I think it's just about analyzing, analytical thinking, all of that. You can create a support system around you, but actually making clear decisions under pressure, dealing with all the emotions that you deal with is a very personal experience that I think is the most important part of being a fund manager.
I love the answer, because I was expecting something like, you need a balance between emotional intelligence, analytical skill, but I like that you need to know how you react to consequences and how much these consequences will drive your emotions versus your more of the analytical part of the brain. I think that's a very wise way of thinking about it, and slowly you get to know how you react as well. So
because not everyone has kind of every tool in their toolkit, but if you've been introspective enough to understand where the shortcomings are, then you can build a team around to sort of help. So I've got team members who will nudge me and say, you weren't saying that yesterday. What's changed? You've got to build a support. So you can only know you can only build support around your weaknesses when you're genuinely honest about what your weaknesses are. And it's such a team sport at the end of the day. But you've got to build those capabilities around where the strengths and weaknesses are.
Yes, no, I love that mindset. Briefly, we'll touch on these two things of how do you. Because there's a lot of learning that you need to do always as a fund manager. How do you incorporate that within your routine? What resources do you use, or learning methodologies?
Yeah, I mean, so the learnings, you can never kind of. You can always be reading things that align to the way you want to. So if behavioral finance is your thing, I mean, the amount of literature out there today that covers the field of behavioral finance is, you could be reading for years on end and not get through half of it. But the key over there is then creating a system of assimilating similar learnings. And so it's a lot of people essentially. What they do is they start creating a system of saying, okay, fine, this goes over here, this piece of information goes over here, and so creating a system whereby then you can assimilate, because the reality is you'll read something and then you won't use it until you're like, now I remember this particular experiment that this behavioral psychologist conducted. And I can't quite remember what the context was, but I think it's applicable over here. And so if you've got a system of shelving away bits of knowledge, then that can really help. And that doesn't have to be like a folder system on your computer, although that's a pretty efficient way of doing it. That's how I do it. but it's still got to be sort of a systematic way of filing away information that's relevant to the job. And so reading a lot, but then having a system to store all of that information is very, very critical. And then, there's a lot of very, very experienced people in this industry that are very willing to talk, actually. And so getting as many coffee catch-ups as you can with people whose investment philosophies resonate with you. People love free coffee. Just, I can't emphasize how much of a help that's been to me, just within my own organization, just meeting with other senior fund managers, talking about their experiences, talking about how they assimilate information and what methods work for them. It's awesome. People are actually very happy to talk. Sometimes we're just a bit too conscious of other people's time.
Yeah. And I think this also touches back on learning how to react. If you talk to someone with more experience, say, oh, this person reacted that way to this event, you get to learn from them as well. So it's not just about asking them about the specific technical aspects. I think it's also, you saw this change in stock X or fund X, and then you get to learn from their emotions as well, not just the technical part of it. Moving more to the future outlook, how do you think the overall future of your industry is changing?
It's an aspect that you touched upon early on, which is it's clear that time horizons and performance metrics are shrinking in terms of people want to make money all the time, constantly, and with no volatility or drawdown, and those time horizons are now that's something that you can say is the way the industry is moving, and you got to kind of adapt and create a working environment that can deal with it. But that also creates opportunities, I think. That kind of creates, I think we can see it certainly amplifies volatility events in the market. The proliferation of the risk manager in the organization means that I think volatility events in the market are being, when they do happen, they get amplified, and that could create opportunity. What's also happening a lot more, and this also touches on, is people trying to, I think the offsetting of a lot of rules onto algorithms, etc. That's happening a lot, and there's a sensible place for that. But when everyone's algorithms are doing similar things, and reacting to each other in certain ways, I think Cliff Asness just wrote a paper, and he's basically making the argument that markets are not rational. He's always said that, but they're also becoming less rational, which means that there's implications for that you have to think about very carefully, because it can carry on being so for very long periods of time. And the adjustments, when they do happen, can happen in very short periods of time. So can you build a culture and an organization to take advantage of that, but then accept that you're going to be on the losing side of a trade for a vast majority of time, in order to make sure that when the correction happens, you can make, so you might end up ahead, but 90% of the time you'll be on the losing side of the trade. Can you build a culture? Can you bring your clients along to accept that that's the way you generate a return in these markets? Those are lots of things that people really haven't put their mind to, which means that emotionally it's a very difficult thing to say, I'm going to wake up today and I'm going to lose some money. I'm going to wake up tomorrow and I'm going to lose some money. I'm going to wake up day after, I'm going to lose some money. But somewhere between now and 6 months from now, I'm going to make a lot of money and we're going to win. It just means that every day there's going to be one good day where you can cheer, and the rest of the time you're going to be feeling miserable. Can you build a culture and an organization that can deal with that? Can you bring your clients along the way if that's what's happening? So I think there's various implications, And there's stuff around technology and the way people have access to finance and everything else, which is great. I'm just talking purely about the art of trying to make an investment return or outperform the market. That game, if anything, is becoming harder with the proliferation of everything we've spoken about. And I don't think we fully thought about the consequences over there.
I think the emotions part is also key again here, right? Because the way you react will slowly adapt to how these technologies work and how your strategy needs to adapt to these technologies.
Yep.
But if you know what's happening and you emotionally adapt to it as well, no matter how technologies change, if you're aware of it and you're slightly ahead of the curve, then you're good, because you're in a way expected these changes. So it's interesting how much that emotional aspect plays a role in your industry, and I don't think a lot of people are aware of it. They think if you're a portfolio manager, you're very good with analyzing these changes, etc. But there's a lot of weight on just being emotionally smart with how you manage things, basically. So I think that's very important. Most of our listeners are people in university graduates or people my age who are early in their career. I'm interested to know, if I show 18 years old Gautam today, would you expect all of this, or like how did your expectations out of college change versus like where you are now, basically?
I mean, massively. There's no way an 18-year-old Gautam Samarth would have known what he was going to do. He wouldn't have known the industry, the city. Never heard of, might have heard of what a hedge fund was, certainly didn't know of what it was. So, and it comes back to what we were saying early on. It's, you shouldn't have expected to know where you were going to end up at age 18. And if you do, there's probably something wrong. Because either you've just experienced a lot, you've seen it all, and you know, or you haven't offered yourself the opportunity to experience it all. And I'm not saying that I've experienced it all, but I've seen a lot more. So your sort of what they call your match quality improves. The more you've tried a few different things, applied your skill sets, and seen what resonates. So an 18-year-old Gautam Samarth, I think, would have just been focused on playing some tennis, enjoying classes at Trinity College, and making the most of life. And thankfully, my advice to an 18-year-old version of myself would be, you did exactly the right thing. Keep doing that. Don't worry about where the future is going to be. It's going to be just fine. Just follow your passions, and it'll be just fine.
And do you think this applies to you now? Like, do you tell yourself the same thing now, that just like follow where things are going, what you're interested in? Or do you think this method of thinking needs to change as you grow older?
I think you're naturally curious the younger you are. So I found that for myself. The older you grow, the more into habits you get. So in some ways, the advice that I have to push myself to is to try to get out of my comfort zone. I fall into a comfort zone pretty often. So I try to get out there, whether it's through book clubs or even experiencing new sports or whatever it is. I find myself having to force myself to go through that sampling, something that I would have done much more naturally as a younger person. So if anything, it goes the other way.
Yes, no. You can survive doing what you do now. Earlier you had to explore new things to survive.
A practical piece of advice is just to write down your thoughts. If it's finance and investments, write down your thoughts about what your philosophy is. Keep a diary. It's a very good way of, one, you never know when you're going to be inspired by a great idea. You never want to lose that idea. So having a diary is a very good way of codifying all the ideas that you have. But also it's a very good way of then going through the journey of things you believed in different parts of your life. And then sort of observing on, but then also assimilating all of the things that you thought were important and all the learnings that you've had over a period of time. So I think being just and nothing focuses the mind and questions what you really believe in like having to write it down. When you start writing things down, you're like, oh, do I actually believe in something like that or not? So it's a very good way of when you're trying to struggle through these career path decisions. It's a very good way of actually uncovering what you as a human being believe. Writing, keeping a diary. So that would be my kind of practical advice.
I don't want to be too philosophical, but I think this ties to knowing how you reacted and what were your emotions in different moments, which ties a bit to your job and what we touched on is super interesting. But I definitely agree, and I think at the moment it helps you process what's happening to you as well. So emotionally you're healthier once you do it. So I definitely agree. It's a very good tip.
Clarity of thought.
Yes. Gautam, thank you very much.
Thanks for having me. That was really good fun.
Time and a lot of insightful tips and stories. So I really appreciate it. Thank you very much.
Awesome, man. Thanks for having me.
Thank you, really.